Xi Jinping, the president of China, comes out and says that they're going to start defaulting on dollar loans and they don't want the US dollar to be the world reserve currency anymore and they're looking at other options. This is really, really bold. This is potentially starting a new Cold War with China, between China and America, way above and beyond the trade wars. So I got the DXY chart up here. This is Brian Lewis with MMT Investing, and things just changed. So, man, there's a lot of international politics stuff going on here, and I want to kind of go through the politics and how that might affect the DXY, the dollar strength, dollar index, and maybe the dollar as the world reserve currency outlook might be shifting to shorter term than I was thinking here. So there's several countries not afraid to come out and say that they're sick of the dollar as the world reserve currency recently in the past month. Russia has been saying this for about a year, I suppose, and Russia is now violating sanctions, building the pipeline against the EU and the US sanctions over to Europe for the natural gas pipeline. Russia is right at the heart of forcing these oil prices down and kind of disbanding OPEC plus. And now the Middle Eastern countries are stacking gold and oversupplying oil and preparing basically to trade oil outside of the US dollar in gold is what it looks like they're trying to do for the most part, which is a huge, huge, that's the entire petrodollar system that America has set up that's being threatened. And let's take a couple looks at the DXY. So yeah, I guess Xi Jinping, when if they default on dollar loans, that would be a major thing, and I guess that would probably be negative for the DXY. But everything that Middle East countries and Russia is doing right now is going to force the DXY up, uh, pretty much against the euro and against all of the commodity currencies. So the dollar should be getting stronger relative to other currencies for a while. I don't think that outlook has changed, and China hasn't actually defaulted on anything yet. They're just threatening, and they're kind of stoking this trade war. And also, Trump is just coming out and saying that China like let this virus out and claiming where this virus came from in China, and uh, it's it's getting kind of ugly, and it's going to be a political mess here. I don't know if that's maybe a plan of Trump leading into the election to get more drama going or something like that. Uh, I don't know how true all of that stuff is. I mean, it's a bunch of politics near an election, so I don't really believe any of it. But what I do believe is what this chart looks like. And let's take a look. And this is the weekly candlestick. So this is a very, very long term outlook at the DXY over probably the next 3 years. And what we get here is bullish, 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 and potentially turning over and getting a little bit less bullish, but that's long-term bullish, and you have to get down to this side to get bearish on the very long term. So that all looks like a stronger dollar, and you can see on the Bollinger Bands that like here a little while ago when we got to the bear side, we were sticking to the downside of the Bollinger Bands, and we had just been sticking to the upside for the most part here. So that's all bullish, and let's switch into the dailies. So this is the few month kind of outlook. Okay, so this is interesting. This is a little bit less bullish, and it's getting more bullish. So we're getting down near boring here, and we're swinging up back into bull territory, and this is just a crazy mess right here. This is not sticking to either side. This is just a wild triangle consolidation, and this is indicating that we're going to go up and the long term is looking a little bullish, and this is looking like it's going to get more bullish. So that looks like up for the DXY. And I don't know if the China thing, if people start defaulting on loans like aggressively, I mean that's a real thing. Like that's kind of like an act of war or something like that. So that hasn't happened yet. It's just a bunch of talk so far. So I don't really believe any of that right now. But the technicals and the cycles are looking bullish. And let's get in on the tight view here and see what we get on the DXY. Let's go to some hourlies. And this is bullish as well. It's swinging back to the bull side here. And it's just kind of swinging back and forth here. So, I mean, it's kind of bullish today. And it just needs to stay up here on the bull side to stay bullish. And it looks like from the previous chart, that's what it's trying to do. But it's really not, man, it's just really not clear. This kind of this pattern is generally a bullish breakout pattern when you get this the diamond kind of thing, but it didn't bull out, it didn't break out, and we're just getting a wedge, not even that much of a wedge because it's just kind of wobbling. Yeah, so on the daily look, I mean, it's sticking to the downs, then it's sticking to the ups, sticking to the downs, sticking to the ups, downs, ups, not really making up its mind, and slightly bullish. So maybe over the next 2 days, it probably will just kind of wobble back and forth a little bit more, slightly to the bullish side. And it looks like we're getting slightly higher lows here and kind of flat on the highs, and it's just kind of an upward kind of wedge consolidation. This looks bullish slightly on the day to day, but it looks more bullish weekly and a lot more bullish out on the monthly to yearly scale. So I would say that the oil and the general contraction, I mean, the oil is definitely part of the contraction thing, but the worldwide monetary system contraction that's on right now is very bullish for the dollar because people just don't have the dollars they need to pay their loans, and the banks can't get more loans out right now. So it's just less money. The banks are hoarding treasuries, and the repo markets, people don't want to trade the treasuries. People are holding them. They don't want to give loans out. People are tight with their liquidity. All these international companies and international banks are holding their dollars, and so it's just less dollars, less velocity, less actual dollars across the whole world right now. And the Fed is trying to create more liquidity, but they're not creating more liquidity this month, and it should reverse in about a month. It should reverse, and we should get more liquidity. And maybe at that point, we can take another look at the DXY and at China saying they're going to default on all their loans. But also, when you get a big monetary system switch, like we're getting right now, like we're kind of moving away from this international banking centered credit. The dollars right now that are the world reserve currency are not the Federal Reserve dollars. They are the international banking system loans that are just loaned out on collateral. And now the Fed is reconnecting and creating all these programs and sort of bypassing the banks. And you see the Fed and the Bank of England openly kind of saying they want to reduce the power of the banks now. And that sounds kind of similar to what Japan did in their bubble. So this is kind of uncharted water, monetary switch in the entire monetary system, and it's looking like a contraction right now for about a month, and then we should get an expansion and we can take another look at all this stuff. But this is going to be really bad for kind of everything, the whole stock market for another month, and the DXY looks good to me. This, I suppose there's more volatility in here than kind of holding dollars, but the general direction of the DXY is up a little bit. So as far as I'm concerned, this is not investment advice, but the DXY looks like a good spot to park some dollars because it's acting a lot like dollars with a little bit of upside against the other currencies, or could potentially short the other currencies, but that gets a little bit more complicated. Like the commodity currencies are kind of under pressure right now, like Canada and Australia, and I'm in South Africa right now. Yeah, my rhino here. So the South African rand is also a commodity currency, and it's under a lot of pressure. So food here has gotten a lot cheaper for me since I've been here, which is uh, kind of cool, I guess, to be spending dollars against a currency that's getting really weak while I'm here. And I don't know if that. I expect it to continue because that's what the chart is showing here. So I think sort of on FX markets, those commodity currencies look like they're under pressure right now, and the euro also. So the DXY is largely against the euro, and so it looks like the euro is going to be doing poorly against the dollar here. And I don't believe that China is going to do what it's saying right now. And I think that might just be some political nonsense just to stir just to stir stuff up for the election campaign thing that's coming up. Who knows? Trump is chatting with China and Russia all the time, and this is pretty tense. But I don't know. I don't know what to think about all of it. I just have the charts. Like the news is not reliable, and as far as I'm concerned, this credit contraction cycle is what drives the news. It's what drives the companies. It's what drives the stock market. And if you can get a good glimpse at what the cycle is doing, you can get a good guess at what everyone else is going to be saying and what the stocks are going to be looking like. And it's really just all about the monetary expansion and contraction. And all that other stuff is just a derivative of the monetary system expansion and contraction. We just kind of hit the max expansion that the dollar could get to across the whole world, and now sort of the collateral backing the dollar. All the oil is backing the dollar is going bad, and then now all the corporate backing, like the corporate equities and the now the mortgage-backed securities are getting big in the repo market again, which is not a good sign. And those aren't quite as big a backing on the dollar, but that's what we got in like the housing bubble crash and the .com. We got the corporate crash. So this is all three: oil and corporate bonds and housing bubble crash and less dollars worldwide. And the Fed, yeah, everyone's saying the Fed is like pumping up the market and going crazy. And that's the opposite of what they're doing right now, actually. All the way that the stock market was getting blown up during the expansion phases leading up to this bubble pop is that they were providing liquidity to the companies, and the companies were using that for stock buybacks, and that was making the stock share prices go higher. And now stock buybacks basically a bad word. The government's coming out, Trump's coming out and directly just telling companies not to do stock buybacks, like making them look bad if they're doing stock buybacks. And for any bailout loans, they're now passing laws that are saying if you get a bailout loan, you're not allowed to do stock buybacks. There's a restriction on that. They could potentially make stock buybacks completely illegal altogether. And that's the main buyer in the entire stock market is gone now. That was, I don't know, the percentage, maybe 70% of all the stock buying was stock buybacks. So the number one buyer in the entire stock market is not there anymore. So that's big downward pressure. On top of the contraction cycle is just the change in policy. And the Fed is creating money, but they're not. They are doing some helicopter money, and that money is going to people that will spend it. That's not going into the stock market. And the majority of the money is not helicopter money. It's bank reserve assets that are going into all these international banks that are hoarding treasuries and they need reserve funds to handle all of these loans that are coming in. There's just going to be a massive amount of loan defaults coming to all the international banks and the American banks, but the emergency fund that the international banks are storing up to handle defaults is like twice the size of what the American banks are doing. Um, so that's where the Fed money, I mean, I believe is going. You don't get to actually see where it goes, and Congress can't ask them where it goes. If Congress asks them where the money is going, they say no. Uh, they don't have to tell Congress where it goes, and they don't. But this is what they're doing. They're bailing out the entire Eurodollar system. It's the international banking system that provides the U.S. dollars to the rest of the world. Has now kind of ground to a halt, and the Fed is now bailing out the entire Eurodollar system. So if you go look at Luke Gerlman, I mean, he has a cool Twitter feed, and he talks about estimates of the Eurodollar system. I mean, he says there's 57 trillion dollars in US dollar loans outside of the USA just from the Eurodollar system, and then almost that many loans in the private sector in the US, and it's like $100 trillion or more out in dollar loans that are owed right now, and people don't have the money to pay those loans. And so this is the contraction. The banks can't lend more money and people can't pay their loans. And the system is just kind of coming back in. And that's why everything's coming down. And that's why all these international tensions are kicking up. And it's just kind of the pop and reversal of this monetary expansion. It's the top of a bubble. It's a sovereign debt bubble. That's what you get. You get to the max expansion and then it starts winding back in. And that's what it looks like. And you can check out all my models for the different bubbles. I have a bunch of sovereign debt bubble videos on like the Japan Nikkei bubble, the Great Depression, the smaller ones like the dot-com and the financial crisis and Black Monday and different bubbles like that. And I have a whole financial history section where I talk about China and Mongolia and Rome and Netherlands and Portugal, Spain, France, like all these different world reserve currencies that have been different blends of fiat and central banking and bank credit and all these systems that we're doing right now. Everybody has done that same stuff for the last 2,000 years, and there's really common patterns and exactly what happens. And I mean, basically, we're switching from kind of the banking credit system that China was using at one point, like a long, long time ago, to the kind of central banking money printing system that Mongolia was using, like with Kublai Khan when Marco Polo was over there. So, like, this stuff's nothing new. Everyone says, like, oh, yeah, the American dollar. No one's ever tried to do a fiat reserve currency before or whatever, like, negative. China had paper bank issued reserve currency, very much like our international banking system. Mongolia had paper money, Fed printed central banking paper money, and Marco Polo talks about that. He's like, Kublai Khan could print up the wealth of the whole empire from his throne or whatever. Same thing that's going on right now. But it is more expansive as far as a world reserve currency. Like America is the first real world reserve currency because the British pound, I mean, the spice empires, like Dutch and Portugal and Spain and British had pretty wide empires across a lot of the globe, but this America's the first real world kind of reserve currency, and it hasn't been straight fiat the whole time. Like it was gold backed from Bretton Woods at the end of World War II in 44. Like we had a gold backed US dollar, and that was a Fed dollar. So that was our world reserve currency for a while. And then it switched over to this euro dollar banking system, which is these international banks. And yeah, so I mean, this is also backed. Like people say this is unbacked currency. It's not. I mean, it's backed by oil, it's backed by mortgage backed securities, it's backed by corporate bonds. The banks hold this collateral and they make loans based on the collateral. This money is it's backed. But now I think it's sort of becoming an unbacked, more central banking system in the Fed now, which is a different system, and that's like the modern monetary system that MMT theory kind of talks about, and we get more centralized. So that's the outlook, and that's why there's so much tension, and that's why things are crashing. It has everything to do with the contraction of the worldwide monetary system, and we should get about another month of contraction, and then we should get. It looks like when you look at the data on Hedgeye, for the cycles, I mean, the growth should be up and down and up or something over the next year, but the monetary expansion should switch to an expansion out into next year. It looks like 9 months of expansion cycles, like 3 expansion cycles in a row after this one. So that's going to be a different investing environment here, and we don't know if we're going to get inflation or deflation over that period. Um, so that's going to be a big thing to look at. And the interest rates are a big deal that everybody's talking about. Like, oh no, negative interest rates are happening. And everyone's like, the Fed is holding the interest rates down to do this and that. And if you talk to, or if you look at Jeff Snyder or Warren Mosler, the MMT theorist, they both say the same thing. And they say the Fed just doesn't control the interest rates, and they just kind of follow the interest rates. And maybe they think they're controlling it, or maybe they realize they're not and they're just kind of following it. But the interest rates move first, and then the Fed sees if it where it is, and then they announce where it is, and they try to hold it there, and they can't. It just goes where it's trading, and right now it's trading around zero, and the Fed's going to zero, and they're like, we're at zero now, and the futures are pricing in negative potentially, but I mean, Europe had negative rates, but negative rates on the world reserve currency is a different thing. Like, if you get negative rates on a fiat world reserve currency, that's going to drive inflation, and inflation is going to drive the interest rates back up. And so that's just a short-term thing, probably. I know people are saying like we're going to get negative interest rates, and they're going to like force it on everybody and stuff like that, but I don't really think they have the ability to do that. It's just going to be a ton of loans and inflation in the short term, and that's going to drive up the rates. And then we're going to have loans with higher rates, which is going to be really tough on everybody. And then it's going to be a mess. So, so yeah, that's kind of the world outlook on the monetary system. And a lot of countries around Asia are trying to figure out another system, and there just really is no alternative to the dollar right now as a functional monetary system between all the countries, and the US enforces the whole system as well, and stops people from trading outside of it. But it's looking like that's not happening anymore. Like, starting this year, there's a bunch of countries that are just saying like, no, we're not doing this anymore, and we'll see what America does about it. But that's the world situation, and that's the stock market crash. And you can follow my market forecast on the stocks here. Oh yeah, and like and subscribe and stuff, and help me out with the channel. There's like a little subscribe button here. There should be, and the like button helps a ton with the YouTube algorithm. And also, just kicking up like a conversation in the comments is probably better than the like button as far as growing the channel. And this is not investment advice or political advice or um, anything to do with the election. I guess I could mention the election really quick, since it's gonna be some drama here, because it looks like we're gonna get the rest of this down cycle right now, and it's gonna be driving up off of a dramatic kind of low all the way through the election. It should be up, and I don't know if it's going to be an inflationary up or a kind of bear market lower up, but it should be driving and stabilizing all the way to the election and past the election based on the cycles that I can see right now. And so the election should be happening at a stable time, and the Fed And Trump should be able to say, like, look, we've stabilized and done all this stuff, and how great are they? And it's just like that's just where the cycle is going to be at that point. And so I suppose that would be beneficial for Trump if the economy is back up at that point. But also, he's going to have presided over the biggest crash ever. So um, that's not going to be good, I guess, on the political outlook. And yeah, as for right now, it doesn't look like any kind of war type scenario is starting. It just looks like people are wanting to go to um, competing currencies for the reserve, the world reserve currency, like basket currencies or a couple different systems. And Bitcoin comes into play here as an asset, and that's kind of what it looks like is happening. Like the dollar is starting to lose its standing as the single world reserve currency. And yeah, there's SDRs kind of, which is a basket of like euros and China currency that they might try, but there's no other system set up to actually function as a world reserve currency. So this is all like hypothetical stuff that can't happen immediately. And Jerome Powell, the Fed, talks about this pretty openly. Like he says that right now they're having to print to keep this system functioning, and it doesn't look like they can stop. And he says we might be switching into an age of competing currencies, very much like we had earlier in America's history, when we were switching over between different European world reserve currencies. Like America had all of the whatever the Dutch and the Spanish money and the French money and the English Empire money, like all those world reserve currencies traded around in the U.S. when before the U.S. was even on the map as someone that could be the world reserve currency. So these world reserve currencies switch between countries all the time, and who knows? Maybe China or Russia look like candidates to kind of lead a competing currency or a basket of countries like that. And I don't expect that to happen very fast. I mean, maybe if things get really dicey, it could be accelerated. But it took from World War One until the end of World War Two for the British pound to switch over to the U.S. dollar as the world reserve currency, and that was like 30 years. So I mean that's the kind of timeline that it usually takes to switch over, 20, 50 years, something like that. It depends how much it goes to competing currencies or if it just switches directly to something else. But as of right now, there's nothing else that looks good. So I imagine that drags the timeline out a bit. And yeah, China's going to default on their American debt. There's no way they're doing that. Man, that's ridiculous. That's a bunch of drama. This DXY chart right here tells you everything you need to know, and it's going up, and that has to do with the contraction and the oil, and that's really what's behind everything that's going on. So that is the political situation across the whole world going crazy. And if you want more information on this stuff, I would highly recommend Jeff Snyder to look up Euro dollars. He's the best. Luke Groman is really good talking about the international banking, like numbers and loans that are kind of available. Raw Paul on Real Vision is awesome at charts and graphs for these kind of international banking cycles. Like I love his stuff because I draw the cycle kind of charts. And then Hedgeye gets the inflation data that's like up and down, and the growth data that kind of you can kind of pinpoint where these cycles are switching and reversing kind of on the quarterly level. So those are some of the best places to go just to kind of check out the monetary contractions. Um, and then as far as the news goes, I mean, I just completely ignore any politician's words. But like a report came out, that the quarterly reports for a bunch of banks in Europe are coming out now, and it's showing that they're just stockpiling massive amounts of cash to handle defaults, and they're providing less and less loans, and the credit cards are providing less and less loans and tightening the credit scores needed for loans, and all the housing lenders are stopping providing housing loans. Like the jumbo housing loans are off the table, and now you need way better credit to get a housing loan. And they're not extending like HELOCs now. They're cutting down the home equity line of credit, and like cash refinances are getting reduced. So this is all part of the monetary credit contraction, and you can see it across the private sectors, and you can see it in the banking sectors. The banking balance sheets across Europe are coming out over the next 2 weeks, and you'll see when those come out how much money they have stashed for emergency now for defaults, and where are they getting all of this extra liquidity from? From the Fed, of course, because I mean, they didn't just have that money just sitting around just in case. Like this is new money that they have liquid to deal with defaults, and that's what the Fed's doing. They're not blowing the stock market up. They are they're providing liquidity in the financial system to prevent defaults so that people can keep paying on their loans. Like that's what the financial system needs, is everyone to pay on their loans. And that's what the Fed's doing. And that's the same reason that helicopter money is coming out to individuals in America. It's not so that everyone can get money and be all excited and happy. And it's so that people can pay their student loans, their auto loans, their rent, their housing, mortgages. It's all the loans that are due in the American private sector. That is what they're targeting with the helicopter money, is they want people to keep paying those loans to keep the financial system stable. And it's not to blow up the stock market. And I think we'll see over the next month and a half what this cycle looks like, and there could be a good bit of downside in the stock market happening now, and then that should reverse out though. Once we hit this cycle, the cycle switch in June potentially. I'm trying to figure out the timing on it. It looks like maybe mid-June it'll switch, and we'll get completely different fundamentals for like 9 months after that. But the next month and a half is going to be absolutely nutty, and I am not giving investment advice for people to be really, really careful. But I can tell you what I am doing, and I have the majority of my money just cash right now. It's just cash. I'm out of the market, and now I'm buying up shorts and just kind of playing around with some short positions. But mainly I'm cash, and kind of on the up moves, I'm looking at gold and potentially oil tankers for up moves, but mostly it's just as long the dollar against this crash, and then shorting kind of whatever's up. Like energy is already down, but tech is up, and that does bad in this kind of cycle. And industrials are way up, and they usually do bad in this kind of cycle. So there's a lot of downside on the industrials. That those could come down quite a bit. And then the international companies and banks, like financials, are already down. They usually do poorly in this cycle, but I don't think there's as much downside space on that. But the emerging market funds and the Russell 2000, those ones are really, really big right now. I was just shorting those today because those are the companies across the world and in America that are not going to get bailout loans. And those companies get in trouble and start going under, and they have to delist them out of the ETFs. And the ETF values can actually go lower than the value of the underlying companies. So I've been shorting the emerging market ETFs and the Russell small caps this week a little bit, and those aren't quite as high as like industrials and tech. So I shorted tech, and I didn't short industrials today because I was not early enough, and they were down too far for me to do it today. But I'll see if those bounce back or what they look like. I'm a little scared to short the industrials. They're on a different angle than the rest of the market. But yeah, the Russell 2000, the small caps are high risk of failure without a bailout, and so are the emerging markets. And there's a lot of different emerging market funds that you could dive into. And I don't dive into them that much on this channel because it's not really a keyword that anyone will find. And I mostly just kind of talk about like Apple or Tesla or something that people actually find, which is way less interesting than the stuff that's actually going to get slammed by this contraction cycle. But for anyone that's still here, you get all the good info at the end of the video after I thought I was going to end it and I'm still talking. So that's the news update, and please hit the like button and chat about all the drama and the presidential election, whatever, in the comments. I'll get in there and chat with you about that stuff. And yeah, happy trading.